So this is my actual stock portfolio, and we'll walk through the top 7 stocks to buy now, each focusing on a different technology trend driving value in the market today. Because when it comes to picking great stocks, it's important that we understand a company's products and not just their numbers. If you had put just $10,000 into Nvidia 4 years ago, that would be worth over $150,000 today. Or just $10,000 into Palantir 3 years ago would be worth over $180,000. And that kind of massive growth happens when a company has the perfect product in a quickly growing market before that market appears. So let's get into it and start by putting my money where my mouth is by showing my actual stock portfolio and not just an iPad. So the past year has been very volatile in my portfolio. It's risen by as much as 40% before dropping by another 30% and then increasing again in the most recent months. This is because I primarily hold technology companies, which is what I know best and what fits within my circle of competence, the area of the market that I think I can outperform in. Because my background is a software engineer and solution architect for Fortune 500 companies. And I balance this volatility by putting 15% of my income into passive ETFs that just track the broader market. But let's now get to my first stock, which has a borderline monopoly in the AI infrastructure space, building the machines that chip makers rely on. And even though the AI space has a lot of hype and high valuations, this stock has real revenue and it doesn't seem fully appreciated by the market. So this first stock focuses on making the machines that are used in manufacturing modern chips, especially the high performance chips used in AI. The way they do this though is not by placing literal wires on a circuit board anymore. Instead, they use a technique called lithography, where you literally write using light. Their machines use a specialized laser to shine onto a wafer and basically etch the different designs that are used for the chip. And what's important to investors is these machines are extremely difficult to build, and one of the biggest customers for this company is TSMC, which is the world's biggest chip maker and the manufacturer of chips for Nvidia and AMD, meaning the current Nvidia-driven AI boom really couldn't exist without ASML. So ASML stock price has been on a tear over the past year. It's up over 100% since 2025. The company's stock growth has slowed down slightly in 2026 though, driven by some risks which we'll touch on in a second. But first, let's take a look at their financial health. The company's health trend, which is calculated from their Piotrowski F-score, gives them a pass in 8 of 9 areas, making it very strong. Their bankruptcy risk is low, and the numbers look legitimate. There's no manipulation risk. So the overall health is pretty strong. And this is why, if we just look at the company's revenue over time, it has been growing so consistently. And on top of that, their gross profits are growing as well. So if you're looking for a picks and shovels play in the AI market, this is the company that is selling the tools that other AI companies rely on. So ASML's biggest risk comes from their newest version of their product, which is a $400 million machine that they hope to sell to TSMC. The issue, though, is that TSMC might not want to pay that much. At the same time, Intel, which is another chip manufacturing company, has already installed the first high-NA EU lithography tool from ASML, which to me shows that eventually TSMC is probably going to adopt these new tools as well. I don't currently hold shares in ASML, but I am actively considering grabbing some. And one warning here, I tend to invest over a long time horizon, so 5 years minimum, but ideally closer to 10 years. So I would be very careful about buying any of the stocks I talk about with the goal of getting a short-term return unless I explicitly say that this is a short-term stock. ASML is not, but this next stock is another very interesting play in the AI infrastructure space. And after this, we'll look at some stocks in other areas of the market that may have even more potential to rise in both the short and the long term. So next up, stock number 6 is Celestica AI, which is a company I first found from an old Seeking Alpha article. But if we look at the company's stock price, it is up over 3,000% since then, with a massive run up recently to a current market cap of just under $50 billion. But their profits have also grown extremely quickly, so there may still be some potential for this stock price to rise substantially from here. So for this stock, I want to walk through 3 main pieces. 1, what about the company's products is making them grow so quickly? 2, what does their price look like, and are they a decent value at today's prices? And 3, how likely are they to continue to grow from here? So starting with the company's technology, the company's CEO says that his company designs and manufactures infrastructure that enables artificial intelligence. The company focuses on three main product areas: storage, compute, and networking for data centers. So if AI GPUs from NVIDIA are like the neurons in the brain, they provide the rest of the brain matter for those chips to run. You can't run AI without the rest of the data center. Now, there's a lot of companies in this space, but what makes Celestica special is just how well they've managed to execute on their vision. And this mainly shows up in the company's numbers. So if we look at the company's stock price over the past year versus, say, ASML, the stock price is up 340%. But the financials behind this company look pretty good. Seeking Alpha puts them as a strong buy according to their quant analysis, with valuation being really the weakest part of this company. They are valued as if they will keep growing, but their growth, profitability, and momentum all look very strong. So this stock is truly a growth play. If you agree with the CEO and think that the current AI boom is not a bubble and that this is going to be a must-have technology, well then their incredible growth that they've seen in their profits recently are probably going to continue, in which case their valuation looks pretty reasonable. On the other hand, if you're more bearish on AI, probably a stock to stay away from. But let's take a quick look at what are the growth potentials from here. So the big long-term driver of growth here is how much money is pouring into the AI hyperscaler space, with AI tech spending expected to reach $700 billion this year. That is real money that is going to real companies like ASML, TSMC, and Celestica. And maybe one shorter-term catalyst, Celestica and AMD have recently announced a collaboration for their new Helios Rack AI platform, which is basically making a product for the data center that pairs AMD computing and Celestica's leading-edge network switch technologies. Because we're getting to the point where what's holding some of these data centers back is just how quickly, consistently, and performantly can you actually deploy this AI hardware. It's the bottleneck. So a stock that's definitely on the riskier side, but may have more upside potential. But let's now move to a very different side of the market. If Celestica is the high growth, high price moonshot, these next two stocks are large established companies that look like an extremely good value when compared to all their competitors in the space. And so these could actually offer a short-term upside as well as long-term. So I wanted to address a comment I've seen that I need to publish more videos and provide more frequent updates. Just takes me a while to make these videos, but there is a cool tool I found that can help fill the gap and provide some really good research-backed stock picks, which you might find useful. So it's called AlphaPicks, and it comes from this video sponsor, Seeking Alpha. AlphaPicks is a portfolio of stocks from Seeking Alpha, which are selected using a combination of quantitative and fundamental analysis, and which have actually outperformed the S&P 500 by over 250% since 2022. AlphaPicks assigns a rating to every stock, so a strong buy, a buy, or a hold, and they update their holdings once a week based on what is happening in the market at that moment. So they mention you could just buy their entire stock portfolio and copy their trades, but what I found more useful is using this as an idea generation tool, using their analysis to figure out which stocks fit my strategy the best. Like when AlphaPicks added AppLovin to their portfolio back in November 2023, citing their aggressive acquisition strategy for buying and building new apps, and their ridiculously strong free cash flow. The stock is up over 1,000% in price since then. Or Celestica AI, which they picked back in October 2023, which is up over 3,000%. Point is, if you get even one good idea from this service, it can pay for years of the subscription. I've also really enjoyed their weekly market recap, which basically explains everything that's happening in the market right now, explained using real data. So it's really high signal and low noise, which is what I care about. So try out AlphaPicks using the link in the description to get a special $50 off an annual plan. Or you can scan the QR code on screen. So thank you Seeking Alpha for sponsoring this video. Clicking that link really helps support this channel, and I can only make videos like this with the support of sponsors like Seeking Alpha. But let's now move on to the next two stocks, which are some of the most important companies driving value in the market today, and their prices make them some of the cheapest companies in big tech. So let's take a look at our first big tech stock. So stock number 5 is Microsoft, which has had an interesting year with the stock price rising by as much as 38% before finishing only up around 11% so far in the past year. And there has been a lot of recent news and some major shakeups with how they are approaching their AI Copilot, but also some signs that this stock may be quite undervalued at current prices, as well as some catalysts that could send them higher from here. So I want to talk through this company in 3 steps. 1, take a look at what's been happening recently with this company and how a $3 trillion stock could potentially rise from here. 2nd, look specifically at their valuation and why this company looks so cheap. And then 3rd, look at some of the reasons that the stock price could rise in the relatively short term from here. So Microsoft is a massive company, especially in the B2B space, where they sell services to other businesses. I mean, most of the world runs on Microsoft Excel and Microsoft PowerPoint, but a bigger and bigger chunk of their revenue now comes from Microsoft Azure, which is their cloud platform. This is what effectively runs the backbone of the internet, them along with AWS and Google. And there's been a lot of conversation around how much Microsoft is over-investing in AI, or how they're kind of messing up a lot of their user-focused products. It's even become a meme this year that 2026 is the year of the Linux desktop, because people are fed up with how many ads Microsoft is putting into everything. But anytime there's a lot of emotion around a company, it offers us an opportunity. And I think the opportunity here is in Microsoft's B2B business, because that is where they're driving the majority of their growth. I mean, Microsoft Azure and cloud services grew their revenue 39% in the past year. 39%. And this is a company that makes over $100 billion per year, while personal computing is only a $14 billion business. But a lot of the news around what's happening in Microsoft right now depends on what's happening with AI. Back in early 2024, Mustafa Suleyman, who's the co-founder of DeepMind, joined Microsoft to lead Copilot, which is what they call all their AI tools. And this guy is very bullish on the growth of AI.
Like over the last 15 years, there's been a 1 trillion-fold increase in training compute. In the next 3 years or so, there will be a further 1000x increase in training compute. My personal mission at Microsoft is to build superintelligence.
So the guy thinks there's going to be a 1000x increase in the amount of computing going toward AI, and his goal is to build a superintelligence. And so as we're starting to see a shakeup in the leadership team that is running Microsoft's Copilot AI, with a former executive from Snapchat bringing in for the AI Copilot assistant, Suleyman is now focusing specifically on creating new generative AI models. So not focusing on the products, just focusing on the raw AI power. This is interesting because a lot of the conversation around the stock, especially from analysts, have been that it's really early for Copilot AI, but this new focus where the head of AI is now focusing primarily on the AI models feels like a much longer term approach. They're not just focused on grabbing as many users as possible, they're actually trying to move the technology forward, which I think is probably the right approach, but it may take longer to pay off for investors. So why then do I like the stock so much in the short term? Well, it all comes down to their numbers. If we look at Microsoft's growth in gross profit over time, back in 2021, they made $115 billion, while in 2025, they made $193 billion. And if we switch to the quarterly view, they're making over $55 billion per month in gross profit. So over $200 billion per year. And this is on top of very strong overall financial health. In fact, if we take a look at Microsoft's PE ratio, the measure of how much they're making versus what the company costs, they're sitting at a ratio of 26.5. And if we compare that to other big tech companies like, say, Google is at 31. If we look at Apple is at 34. Even Meta, who is their cheapest competitor right now, is still more expensive than them at 28. So if Microsoft's valuation were just to match Google's current valuation, that would be a 17% rise in the stock price from here. So there is some short-term upside, but I'm more interested in the long term with Microsoft. And I have kind of an overall thesis here and then 2 pillars that support it. The overall thesis is that Microsoft Azure will continue to grow and gain more and more customers as the cloud in general is glowing. And there's 2 pillars that I think support that the market may be underweighting. The first we've already talked about, Microsoft Copilot. I don't know about you, but I hate using Copilot. I don't think it works very well, and in most products, it's kind of annoying. But that's just on the product side. In terms of the AI models, Microsoft hasn't really unleashed their full potential by focusing on creating new generative AI models, and that is now changing. So I think that for the first time, Microsoft is actually focusing on the most important part of the AI pillar. The second pillar for Microsoft is what the next technology is going to be. And there's some decent signs that that could be in the quantum quantum space. Microsoft has made the Majorana 1 chip, which uses a unique architecture for what they say solves meaningful industrial scale problems in years rather than decades. We'll talk about quantum computing more later in this video, but I did want to call out Microsoft here because they are inventing some pretty cool technology in this space. There's this really interesting article where they break down exactly what they are using, and I'm not going to go through all this in this video, but I'll leave this link on my stock desk, which is this research dashboard here, and you can access this in the description completely for free. So Microsoft's stock price is being beaten down by bad press. Their long-term potential looks really good, and their short-term valuation looks pretty cheap. I think Microsoft is a pretty solid pick. Also, you may have noticed video chapters are back for now. I'm still trying to figure out why those chapters sometimes hurt the video in the algorithm, but if you like them, comment below, let me know, and maybe help boost the video a bit so that we can keep on doing this. But if Microsoft has struggled for the past year, let's take a look at a big tech stock that is up nearly 300% in the past year, but still has some really strong reasons why it can continue to rise from here. And then we'll take a look at the quantum stocks and then one major energy stock that I think the market is totally missing. So stock number 4 is Samsung, and Samsung really touches on all areas of the computer hardware market, which is a big bottleneck right now for AI data center investment. But for a company this big, there's so many people analyzing it that to get the stock at a deal, we need to identify something about it that the rest of the market is missing. And I think that is in the high bandwidth memory market. So if we look at Nvidia, their breakthrough and why they're now a multi-trillion-dollar company was they made better GPUs that can process absurd amounts of information to run modern AI models. But if you can't feed data to those GPUs fast enough, then performance stalls. That's why companies like Samsung built HBM, or high bandwidth memory. High bandwidth meaning it can provide a lot of data very, very fast, and it's placed close to the GPU to enable faster data transfer for processing. And they recently revealed their plan to dominate the AI market. So 3 things. 1, let's look at Samsung's plan to win in memory. 2, let's see why Samsung stands out as an investment. And 3, map out when it makes sense to buy or sell this stock, as well as how you can buy it, since it's not available on normal exchanges. So let's just start with their plan. Samsung recently launched their own HBM4 product, and they are already pushing prices higher due to excess demand. It's just supply and demand. Demand is so high that Samsung is now raising prices even though they just launched it. And that demand probably isn't slowing down. I mean, if we look, Amazon alone is expected to spend roughly $200 billion in 2026, Alphabet up to $185 billion, Meta over $125 billion, Microsoft near $100 billion. That's not theoretical spending, that's real budget allocated to spend on AI infrastructure like memory. And it's not even slowing down. That rate of spending is still accelerating, with the HBM market growing at nearly 27% compounded for the next 5 years. So the plan for Samsung is pretty simple. They don't need to market, they don't need to sell, they just need to supply all that demand that is there. And Microsoft is pretty uniquely positioned to take advantage of this. They've already signed a deal with Nvidia to supply their next generation of high-end chips using Samsung's HBM4 in Nvidia's ultra-high-performance Vera Rubin model, alongside SK Hynix. And that is really Samsung's edge in this market. If you look at this chart, there's really only 3 companies that dominate in the high-end memory market. It's basically an oligopoly where fewer competitors mean there's more pricing power for the big guys. But Samsung stands out for 2 unique advantages. 1, they're just really big, they have a lot of capacity, and 2, they can shift that capacity toward higher margin products like HBM. And this is working. Samsung tripled their profits in the most recent quarter, with the company expecting demand to continue rising throughout the year. And that number is just absolutely crazy. Samsung's been around since the 1960s, and in the last year, they have grown twice as much as the previous 50 years combined. And while Samsung's stock price has seen some crazy growth, I mean, they're up over 300% in the past year, SK Hynix is up double that, 600%. And another competitor, Micron, is up 560%. So for this stock, it's really a question of growth. If they can maintain their insane recent growth rate, then the stock looks pretty cheap. But if that growth starts to slow at all, the stock price would still be on the more expensive side. So let's take a look at the exit and when it would make sense to buy versus sell this stock, as well as how we can actually potentially buy it. So one big risk here, Samsung has a lot of exposure to both the US and the Chinese memory markets, and we've recently seen some rising competition coming out of China. On top of that, Samsung is based in Korea, so any kind of US tariffs or global instability is going to hit them before a US company. So if I were holding Samsung, I would hold as long as demand stays high and prices keep on rising, but if Samsung's margins start to drop or they lose pricing power, that's when I would probably sell. But how do we even buy Samsung? They're not based in the US, so you can't just go on Robinhood and search up Samsung. So there's kind of three ways you can buy the stock. Samsung actually has a whole page on their website talking through this. If you're in the UK, you can buy basically a proxy for the stock using a somewhat complicated process, but you can use all the normal brokers to do that. If you're in the US, if you have access to a UK broker, you can do the same thing. Or you can buy an ETF that contains Samsung. One of them is EMEQ, which is made up of 11% Samsung, 12% TSMC, and 13% SK Square, along with 10% SK Hynix. So a lot of memory exposure. Or for even more Samsung exposure, you can get the iShares MSCI South Korea ETF, ticker symbol EWY. That's going to give you 23% Samsung and 22% SK Hynix. But let's now move to stocks number 5 and 6, which are in the quantum space, and after this, I'll look at the top stock that I have been buying recently, which sits in the energy space, which is really lucky timing given what's been happening with oil prices recently. So our next stock is in the quantum computing space, which seems like kind of this science fiction moonshot technology, but actually, as we start to push the limits of what traditional or so-called classical computers can handle, the next frontier is quantum computing, a market expected to grow at 32% annually, potentially reaching $170 billion per year by 2040. So I first learned about quantum computing when I took a boot camp that was actually run by the next stock on this list, and this really captures my main reasons for why I'm investing in this quantum stock. So stock number 5 is IBM, a legacy tech company who's in a lot of ways been behind on cloud and AI. They're a small fish there. But specifically in quantum, IBM's story looks very different. They have been in this space since 2019. I remember I tried using a quantum computer through IBM's cloud around this time, and they have been a leader ever since in both raw research and development, as well as teaching customers how to use their products end to end. So if and when quantum becomes the next big thing, IBM is ready for it. So 2 big ways that IBM can win in quantum, and then we'll take a look at their risks as well as exactly when I would sell my IBM shares. So the first way IBM wins is technology. Technology-wise, IBM has probably the most mature quantum ecosystem there is. The company announced their new Quantum System 2, which moves beyond just a science experiment-looking machine to a new system that is modular and able to be deployed in the real world. But what makes this super special is how it actually connects to IBM's existing cloud infrastructure. So if you have a laptop, you can log in and run quantum code right now. They also have a bit of a moat in their open source software, Qiskit, which is the world's most popular quantum development framework and SDK. This software is, I would say, the entry point for most quantum developers. It's now been used by over 600,000 developers, which means there's just this massive user base of people who, when they think quantum, they think IBM. And because it's open source, you can bet that all the LLMs are trained on this SDK, and they will know how to vibe code using IBM's technology. And long term, the company has announced a $150 billion investment over the next 5 years to aid in their quantum push. So R&D is not slowing down. Outside of technology, the other big reason I like IBM is their overall business model, which is essentially cloud computing plus consulting. So you sell your cloud customers over into consulting, and you sell your consulting customers to use IBM cloud and services. So in the same way you can store your data or run a website on someone else's cloud, you can run quantum computing directly on IBM's cloud as well. So now, if you're a pharmaceutical company, which is one industry that will use quantum computing the earliest, you don't have to run your own super cooled quantum computer in the basement. In fact, the Cleveland Clinic, which is known for some of the most cutting-edge medical research in the US, has had an IBM Quantum System 1 deployed to it since 2023. So there's a lot of reasons to be bullish on IBM long-term, but there's also some risks that we need to take a look at. Biggest risk, IBM is clearly behind in AI. You remember IBM Watson? It's the AI computer that beat Ken Jennings in Jeopardy back in like 2011. Well, since then, Google, Anthropic, OpenAI, they've all passed IBM in AI. In fact, the stock has been dropping heavily on AI risks recently. Now, they are getting some boost from cloud infrastructure growth. They're up 21% year over year. But if you remember, that's actually less growth than Microsoft Azure, which is a much bigger company. But that being said, IBM hasn't lost the AI race here because one of the biggest use cases for quantum is in AI. Quantum computers can train AI models to solve problems that are otherwise not solvable in a reasonable amount of time. And on top of that, IBM's stock price is relatively stable and their valuation isn't crazy high. It's a relatively stable stock, at least according to StockDesk. And so I'm okay holding this one for the long term as quantum continues to develop. I currently own 30 shares in IBM, which is actually down around 13% since I first bought into it. So definitely a long-term buy and hold on this one. But now let's look at our next quantum stock, and at the end of the video, I'll share my full stock portfolio, including all the companies I didn't have time to cover in this one. So stock number 2 on our countdown has had a pretty wild volatility over the last 5 years, although it is up 150%. But this stock is approaching quantum from a different angle, from the cybersecurity approach. In fact, quantum security is one of the main reasons that companies are investing in quantum computing right now. So stock number 2 on our countdown is Cloudflare, which is a company I've covered before, but one of their primary jobs is protecting both websites from bad guys, as well as protecting the entire internet infrastructure from bad guys, because Cloudflare actually runs a pretty big chunk of the internet's backbone on their services. And a big concern right now is what's known as Q-Day, which is the day when quantum computers will be able to break public key cryptography. What that means is it's kind of like Y2K, when people were scared that computers would all break down when the millennium digits switched from the 1900s to the 2000s, and everybody had to invest in fixing all their systems. And it worked. The Y2K bug ended up not being a big deal because everyone fixed their computers ahead of time. But the issue now is we're going to see the same thing with quantum computers, which are going to be able to decrypt a lot of encrypted messages that have been captured over the years. This is why organizations like the NSA have announced specific quantum-resistant algorithms which can actually protect against quantum computers trying to brute force these encryptions. And this is one of the areas where Cloudflare comes in. Cloudflare is currently targeting 2029 for full post-quantum security. Today, they've reached the point where all the websites running on Cloudflare are resistant to quantum hacks as of 2022, and 65% of their human traffic is quantum encrypted, not necessarily all the AI traffic that is currently coming to them. And Google specifically is concerned that Q-Day could come as soon as 2030, with IBM expecting that some of these attacks could hit as soon as 2029 for high-value targets. And this all ties in with why I like Cloudflare so much as an investment, is they are, in my opinion, the most innovative company on the planet. They keep a very open blog where they talk about everything that is currently happening in the technology space. In fact, they recently expanded their agent cloud to power the next generation of AI agents, basically getting in front of what's happening with Anthropic and OpenAI and Google. Cloudflare doesn't need to invent the next AI models. They just need to provide the infrastructure and services so that people building these models can actually use them on the internet. I kind of think of Cloudflare like a utility company for the internet. Their job is to make the internet itself work better, however that ends up turning out. And they have done an exceptional job with that so far. In February 2026, they announced their revenue for the fourth quarter had reached $614 million, up 34% year over year, with their CEO specifically citing the shift toward AI and agents being a fundamental replatforming of the internet, which is driving demand across their services. If you think of an AI agent as a new web user, Cloudflare doesn't care if they're a human or an AI, they get paid either way. And we can really see this in Cloudflare's numbers. If we just take a look at their revenue chart, it's grown effectively exponentially, and maybe more importantly, their gross profits have increased at an even faster rate. So the company's revenue is increasing, but their profits are increasing as well. The company is still technically not profitable from a GAAP accounting standard, but their losses have decreased every year, meaning they're on a really good trajectory to become profitable in the relatively near future, which would open them up to, for example, being added to the S&P 500, which tends to boost a company's price. So what would cause me to sell this stock would be if their growth starts to decline substantially, especially the growth in their gross profits, or if their losses start to increase again as a percentage, their margin goes down. The third thing that would cause me to sell would be their CEO leaving, because I just think the internet is in such a volatile place right now, and part of the reason I'm investing in the stock is I really like their CEO and how he's led them so far. So if he leaves, I'd have to reevaluate how they fit into my portfolio. By the way, I will share my full stock portfolio at the end of the video, but I currently own 172 shares in Cloudflare, currently up about 200% overall to $36,000. It's one of my biggest positions. But now let's move on to the stock that I've been buying the most of in the past month, and then after that I will share my entire stock portfolio, including the companies I didn't have time to cover in this video. But let me know if there's any stocks you think I should be looking at over the next month. Let's just stick to companies over a $5 billion market cap and avoid any penny stocks. So let's now look at a stock in the energy sector, which is the company I've bought the most of in the past month, and then we'll look at my full stock portfolio. So the story of this stock all has to do with what is happening with energy in the US right now. This is a chart of the different sources of energy over time, and as you can see, natural gas and renewables have been some of the fastest growing areas, while coal and petroleum have declined and nuclear has basically been flat. But this is starting to change as the percentage of energy used by data centers, especially those powering AI, is starting to grow over time, more than 10% of all electricity by 2030. But what matters to investors is where this increase in energy demand is going to come from. And it seems like most companies are focusing on clean energy. And this has led a lot of people to say that the biggest winner in AI could actually be energy companies. And my top pick in the energy space is Constellation Energy, ticker symbol CEG. So 2 quick reasons why I like the stock, and then I'll show my full portfolio. So we've seen a lot of big tech companies investing heavily in carbon-free energy, and the #1 company for that sort of energy in the US is Constellation Energy, with some people thinking that it may become the most valuable asset to the AI grid that is powering all these data centers. Last year, they signed a 20-year deal with Meta for clean nuclear energy in the state of Illinois. Similarly, Microsoft has signed a contract to reactivate 3 Mile Island, and they're actually paying a premium for this power. Nuclear power is a core part of Constellation Energy's plan to continue to grow in the US, because realistically, it's the only way to produce the amount of clean energy that these companies are demanding. And so then an obvious question is, well, why haven't other companies already been investing in this area? And the biggest part of that seems to come down to public opinion. The 3 Mile Island nuclear accident, which happened back in 1979, effectively stalled the growth in nuclear energy in the US. You can literally see, here's when the 3 Mile Island meltdown happened, and here is public opinion opposing nuclear power after that. A lot of people are just scared of nuclear power, which is interesting because if we actually look at the data, the safest form of electricity is solar power, but the second safest form is nuclear energy, and that is including disasters from older style power plants like Chernobyl and Fukushima, which were way more dangerous than modern power plants. In fact, nuclear energy is even safer than wind energy, and it is orders of magnitude safer than natural gas, oil, or coal. And so this is my favorite type of investment. It's an investment betting against the grain, what most people believe, but following the actual data rather than emotion. There's a disconnect in the market here between what people believe and what's actually true, and Constellation Energy is a way to profit off that disconnect. But that's longer term. Nuclear power takes a while to spin up. The second reason I like Constellation Energy is what they're doing in the short term. See, at the beginning of last year, they bought a company called Calpine, which was one of the biggest natural gas companies in the US. Here's a chart of the nuclear and wind plants operated by Constellation Energy, and blue are the natural gas plants operated by Calpine. With this acquisition, Constellation Energy now goes from nuclear being the biggest source of energy to natural gas being the biggest source of energy, meaning natural gas will be the stopgap in the short term to power all these data centers until that nuclear capacity comes online. So they get to capture all that extra revenue in the short term and then make the massive profits down the line as nuclear is adopted more. That is why I bought 30 shares in Constellation Energy on April 4th, and I shared this along with all my other trades on StockDesk, but I promised I would share my full stock portfolio on screen at the end of the video, so here it is. If you follow me on Instagram at RealFinTech, I'll be sharing this there along with daily updates on the stock market. And if you liked this video, YouTube says this is the best video to watch next, handpicked by the algorithm just for you.